everybody, Nate here, and the Federal Reserve just finished their most recent FOMC meeting where they made some major monetary policy changes. They just announced another huge interest rate hike and even more measures for their quantitative easing program for Wall Street. And today we're going to be breaking down exactly what changed in this recent FOMC meeting, how that is going to affect our entire economy, and more importantly, inflation, and what we can expect to see from the Federal Reserve in the future. More importantly, when they're going to start lowering their interest rates again, and that might be a lot sooner than you think. All right, so let's go into exactly what happened during this FOMC meeting. The Federal Reserve just raised its benchmark interest rates by 0.75% for the second straight time. This is the most aggressive that the Fed has gotten on inflation and its monetary policies since the early 1990s. In addition, the Federal Reserve is starting to roll off a lot of its investments and assets from its quantitative easing program. So it expects to have around 95 billion of its assets completely rolled off and out of its possession by sometime in September. In addition, the federal funds rate now sits at around 2.2 to 2.5%. That is up from around 1.5 to 1.75% that they set back in June. Now, the Federal Reserve believes that inflation is highly elevated in our economy. On the last consumer price index, inflation was around 9.1%. That means for basically an entire basket of all of the goods and services in our economy, the average price went up by 9.1%. So things cost way more than they did just a year ago. And they said that job growth and job gains have remained strong over the last few months, and they are definitely right there. On the last jobs report that we have for June, well, we still have a lot of job postings, and the unemployment rate stayed at around 3.6%. That is almost completely hitting that maximum employment level that the Federal Reserve wants to get to. But they said that the reason that inflation is still so high is because of a broader list of price pressures, namely China lockdowns and of course the war between Russia and Ukraine. And the Federal Reserve stuck to their word, saying that they're going to bring down inflation at no matter the cost, even if that means a slowing economy. Now, with that said, here's exactly how that's going to kind of shape our economy in the future. The Federal Reserve has the power to control demand in our economy. They can actually spark demand by lowering their interest rates and pumping a whole lot of money into the economy, which makes people go out and spend, and they have the ability to get a loan or provide more investment to businesses because money is really easy to come by and it's pretty cheap to take on debt. So they can spark an economy and they can stimulate it, but they can also bring down demand and eliminate a lot of that spending by raising their interest rates. And that is exactly what they're trying to do in 2022. This is not the first time the Fed has raised its interest rate during this year. They raised them by 0.25% back in March. They raised them by 0.5% in May, 75 basis points or 0.75% in June, and then now again in July by 0.75%. In doing so, people can't go out and get a mortgage or they can't spend on businesses anymore because money is a lot harder to come by. You need a lot more of it, and there just isn't as much money circulating throughout our economy right now. Immediately, that means that spending is going to go down in our economy. Interest rates are going up, so it's going to be a lot tougher for millions of Americans to get things like an auto loan or a mortgage or spend on credit cards. All of that debt becomes a lot more expensive, and for instance, in 2020 and in 2021, the average 30-year fixed interest rate for a mortgage was around 2 to 3%. Now it's nearly double that, which means you're going to be paying double what you would before just for that same mortgage. That stretches across everything, and if you have credit card debt right now, well, those come with adjustable rates. So the interest rates are starting to rise, meaning all of that debt is only getting a lot more expensive. And we definitely can't overlook the effect this is going to have on businesses. As those interest rates start to go up even more aggressively like they are right now, businesses are immediately going to suffer. Investors can't take out loans or give a lot of these businesses debt because they simply don't have the cash themselves. With investors and businesses not getting any of this extra liquidity or capital or debt or whatever you want to call it, well, their business can't grow as fast, which means they're going to eventually have to stop hiring, and they might not be able to keep the people that they have right now, leading to higher unemployment. The biggest takeaway from this recent FOMC meeting is that the Federal Reserve is very serious, and what they want to do right now is do everything that they can to limit demand in our economy. The higher those interest rate goes, the lower spending is going to be in our economy, and that is for for everything. And that is why a lot of investors and businesses are worried right now. You see, in 2020 and in 2021, there was so much money everywhere. In a response to the pandemic, the Federal Reserve and the United States federal government printed trillions of dollars, and also the Fed lowered its benchmark interest rates to nearly 0%. They wanted to stimulate the economy because millions of people were out of work, and without that money flowing into our economy, we are immediately going to go into a recession. Businesses have no money from investors, and they also have no money because people aren't buying things. So all of that money was there, all of that money was being poured into our economy, but at the end of the day, that created a lot of inflation. Inflation by definition just means that the monetary supply of a country is going up. At the start of 2020, we had around $3 trillion in circulation, and now in 2022, we have over 20 trillion. So there was all of this money created, but nobody was really working, so it was all kind of artificial, leading to a spike in demand for just about everything. This went on for a very, very, very long time until the Federal Reserve started to address inflation by the middle parts of 2021. At first, they said that inflation was transitory. The Treasury Secretary Janet Yellen said the exact same thing, and President Joe Biden reflected this as well. All of these problems are supply chain issues, and eventually inflation is going to go away. But inflation didn't go away. We're still facing it today because of a lot of that money that was printed, high demand, and yeah, they're right about the supply chain problems. The biggest question on the minds of Americans and businesses and, well, just about everybody is, are these interest rate hikes and these new monetary policy changes actually going to bring inflation down? Well, more than likely, no. You see, what you have to understand about the Federal Reserve is that they only have so much power over inflation and our economy. Like I said before, the Federal Reserve can spark demand and they can also bring demand way down. When they spark demand, well, they're lowering their benchmark interest rates and they're putting a lot of money out there, but that also means that inflation is going to go up because prices have to rise. People are going out and buying a lot more than they did before, signaling to businesses that they need to produce more. They can do the inverse by raising their benchmark interest rates, but the problem is, well, we also have other inflationary problems like the war between Russia and Ukraine and China lockdowns. Not only that, but our country is going through something called the Great Resignation right now, where millions of Americans are anticipating that they're going to quit their job within the next few months. That means that overall productivity is starting to slow, and the Federal Reserve knows this. They know that people are quitting their jobs. They know that things are rotating around, so things aren't getting made like they used to back in 2019 and before. But the Federal Reserve raising its interest rates isn't going to directly help the price of food and energy all throughout the United States. The reason that a lot of those prices are high right now is because of what happened during the height of the pandemic. We had all of this money printed and people were getting money even though they weren't working. They weren't providing any value, but wealth was being created out of nowhere. So Americans went out and spent this money, and with nobody working, nothing was getting made, and eventually people did get back to work after economic lockdowns ended, but they were so far behind, and pretty much the entire world was behind. They had to kickstart everything, but we don't have quite the supply that we need as of yet. Not only that, but pandemic problems all throughout the world and monetary issues all throughout the world are making things even tougher for supply chains as well. Energy prices are going up because of the war between Russia and Ukraine, and that's hurting our supply lines too. So with all of that in mind, the Fed raising its interest rates isn't going to help that, at least not directly. But at the end of the day, the Federal Reserve still has a duty to the United States and the federal government to lower inflation as fast as possible. They have to do this because they don't want the entire United States dollar to lose all of its value. The US dollar is the current reserve currency of the world, which means other countries want it. They want to take on our debt because they want US dollars. But China and other nations are starting to lower the amount of debt that they're taking on from the United States because the US dollar is losing value like crazy right now. The more that happens, the less our money is going to be worth and the less power we have in the world. So the Federal Reserve doesn't want that. They want to bring inflation down, even if that's at the cost of causing a recession. A recession could come from all of these interest rate policies, and I know what you're thinking, well, how? If they don't control demand that much, if they don't control prices that much, how exactly is it going to cause a recession? Well, that's because the Federal Reserve indirectly is going to affect a lot of jobs and a lot of inflation and prices in the US. With them raising their interest rates, that's going to be a lot harder for businesses to get capital and a lot of their debt. Eventually, these businesses are going to start laying off people, and we have started to see that in 2022 with a lot of your major tech giants and other industries laying off people. Unemployment could start going up in the United States because businesses aren't making the sales and they don't have the same liquidity as they did before. So naturally, if people are not making any money anymore, well, then they're not going to be able to buy things. Unemployment is going to go up and prices will have to come down because nobody is buying anything. Naturally, demand is going to get sucked out of your economy. It's not direct demand like in the mortgage market, although you will start to see that in 2022. It's going to be indirect demand like food and energy prices. And really, this is the only thing the Federal Reserve can do. They don't really have any other powers. They can print money, they cannot print money, they can raise their benchmark interest rates, or they can lower them. And it's important to keep in mind here that the Federal Reserve has to do one thing or the other. They can either fight inflation and do everything they can to bring it down, which is exactly what they're doing right now, or they can do the inverse. They can stimulate the economy and they can cause a booming economy. Now, here's kind of the interesting thing about the entire situation. The Federal Reserve right now is fighting inflation, and inflation continues to go up in the United States, but a lot of experts and investors are anticipating that the next CPI report is going to show a slight lowering of inflation. The main reason is because energy prices in the US have come down, like gas prices. Gas prices and energy prices alone comprise around 30% of the consumer price index because most Americans spend most of their money on food and energy. With those prices coming down, then inflation is going to come down a little bit. But here's the thing, inflation is most likely going to go back up, but what's interesting is the Federal Reserve going to take this as a win and reverse a lot of their monetary policies? Now, we don't know exactly what they're going to do in the future because I don't have a crystal ball and I can't foresee things that, well, haven't happened yet. But the Federal Reserve at the moment has an inflation target and an inflation goal of 2%. Right now, inflation is 9.1%. They want to bring it down to 2%. But depending on if we go into a recession, will they start stimulating the economy a little bit earlier? Will they say, well, we know inflation is 4%, but we're going to start printing money again and we're going to start lowering our interest rates because the economy is in a recession and people are suffering? Or are they going to stick to their word and say, nope, inflation is 4 or 5%. We have to get it down to 2% before we do anything else. And that is going to determine how long and how bad the possible recession gets in the United States. Right now, experts don't expect the Federal Reserve to start lowering their interest rates until at least 2024. But experts have been wrong, and the Federal Reserve is not always clear about what it's going to do. I remember back in May, they said that they were not going to raise their interest rates by 0.5 percentage point or by 0.75%. That wasn't even in the conversation. That's not even on the table. And then they came out and said that they were going to raise them higher than people were anticipating. Markets fled from there. The stock market went down. The housing market is now slowing, and so is the auto market, because that was completely unanticipated from the Federal Reserve. So you have to keep in mind that the Federal Reserve can change their mind, and they have done that in the past. They might get more aggressive during their next meeting, which is in September, or they might get less aggressive. It really just depends on what inflation is, if we are in a recession, and what our economy looks like. So right now in the United States, the fight on inflation continues from the Federal Reserve, but is it actually working? Well, that's yet to be seen. But now I want to hear from you on this issue. What do you think about the Federal Reserve raising its benchmark interest rates by 0.75%? Do you think this was the right move, or do you think that the Federal Reserve needed to do way more or way less with their monetary policy? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts us together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.